February 19th, 2025. Let's talk briefly about diversification with alternatives. A frequent way to diversify stock portfolios is with the use of alternatives that offer very low correlation with equities, but there is no free lunch. Some people say diversification is a free lunch, but this is not true in general. Too low diversification and you get no benefit, and too much diversification and it results in basically capital preservation. You are not doing anything. You don't have any reasonable returns over the long term. So based on a recent discussion on X, and after someone made a rant about levering allocations could manage futures, let's discuss this briefly. Before we start, this is the disclaimer: there is no investment advice in this video. So we will start with the performance of the S&P 500 total return from May 18th, 2019, which coincides with the release of the DBMF ETF, because we're going to use that in the examples. So let's see the first slide. This is the performance of the S&P 500 total return. This is the SPY ETF, SPY, and the annualized return is 15.68%, and the Sharpe ratio is 0.78. The maximum drawdown is 33.7, as you can see here, but there is a large down year, minus 18.18% in 2022. I'm sorry. So this is basically not desirable. We need to reduce this volatility and also find a diversifier to have a more robust portfolio. So what are we going to do? Let's look at the next chart. This is the performance of the DBMF ETF from inception to the same period, February 14, 2025. We see that in 2022, actually, it had its best year since inception, 21.61%, and only fell in 2023 when stocks actually had a large gain of 26.18. So due to the low correlation of 0.15 and a beta of 0.09, we think this is a good alternative asset to use in the diversification. We're going to, instead of a 64 in stocks and bonds, with dramatic consequences, dramatic results in 2022, with a large loss, about 23% with the TLT ETF. We will use the DBMF ETF, 60% in SPY and 40% in DBMF. So here you see the result. Actually, 2022 has a loss of only 5.2%, and this is 12.8% annualized return, and the maximum drawdown drops to 23%, and the Sharp is very close to 1.96. Now, here is where the problem comes with these people that claim they can lever this allocation to the volatility of SPY and get alpha and outperform. Because as you see, the annualized return of 12.6% versus an annualized return of 15.68% for the SPY ETF is a huge difference in total return. So they claim they're gonna take this diversification, this portfolio, and lever it up to the volatility of the SPY. So the volatility here is 23%. SPY is about 20.07. So that's 1.5 leverage. So we're gonna do this, and we're gonna leverage this allocation, and we get indeed a very high annualized return, 17.1%, and the Sharp ratio is 0.93. But here is what happens. When we do this, the maximum drawdown increases to 32%. And of course, the correlation with the market gets as high as 0.93%. So we haven't achieved anything basically with this leveraged allocation. We got back to the drawdown of the SPY, which was about 33%. We got down. We have now 32%, and the reason we were looking for an allocation was to actually reduce this risk, because ultimately drawdown is what creates panic and is the biggest risk factor in investing. So the idea that you can get an allocation 60-40 and lever it up to the volatility of the benchmark, it's not a good idea, because actually, despite the fact that the correlation with stocks is very high, a few things can go wrong. And we know what went wrong with the 60-40 in stocks and bonds. Bonds and stocks became highly correlated in 2022, and we had this big loss. And the same could happen conceivably with the stocks and managed futures. Why not? Is there a principle, a law, finance law, or an axiom that says that futures, managed futures, and stocks will never get highly correlated while they are both dropping? I don't think there is one. So I was amazed to read through this long rant of an account on X who was trying to prove that if we lever this portfolio, we get better results. Yet, yes, you get maybe 200 basis points better than the SPY, 15.7% versus 17.1%. Or maybe this is like 140 basis points. gain in annualized return. It's significant. It's significant. Anything above 1%, it's significant, but the drawdown is high. We got back where we started, and look what happened with the SPY. The drawdown was in 2020, the highest drawdown, and also we get the same large drawdown in the lever portfolio in the same period, but in the unlevered portfolio, the highest drawdown was in 2023. So you get something, you give back something else. There is no free lunch with diversification, with alternatives. In this case, managed futures, you have to find something different, something that has alpha with a much lower drawdown. The 20%, you can see it here, the 20% maximum drawdown of DBMF ETF, that's too high. And a volatility of 12.6%, it's too high to get some reasonable results after leverage. So you have to find something else. What this something else could be? It could be investing in another alternative like private equity or real estate or something else. I don't know, but these are not, there is not enough data. There is controversy about those alternatives. For instance, private equity, it's called by a very famous fund manager, volatility laundering. Or you can go with the specific manager who has demonstrated high alpha. For example, here you can see one of our trend following algorithms for futures, long short with 23 futures, 14.5%, but this still has a large drawdown, and the volatility is 17.6%. And going with a specific manager introduces specific risk. It's like investing in one stock that looks has good prospects, but there is always specific risk. So this is the relative performance chart. The DBMF ETF from its inception is 50.7% total return. The 60/40 in SPY DBMF is 99.5%. SPY is 132%, and the leverage to allocation by 1.5 is 149. So from the 60/40 without leverage to the leveraged allocation, we gain 50% in total return in this period from about 100 to 150, but we get the same drawdown that we had with the SPY, almost the same drawdown, 32%. And the volatility is too high, 18.3%. So this is not a free lunch. This is not the way to do things. Another way to do things is through strategy ensembles. But in that case, you have to find an ensemble that generates a high enough annualized return at maybe volatility below 10%. And then you can leverage that 2 times, basically, or even more, and get a leveraged alpha This is what we do with our weekly signals. We have 6 strategies in an ensemble. The annualized return over the years is 8% and volatility is below 10%. Everything I mentioned is a back test, of course, and also this chart is a back test. I forgot to all these charts are back tests, and there is no investment advice, as I mentioned in the beginning. So this is the idea. There is no free lunch, as some people, especially marketing departments of ETF products and funds, they want to convince individuals that there is individual investors, that there is a free lunch with diversification. There is no free lunch. Sometimes it's good, sometimes it's bad, sometimes it's a disaster, sometimes it's spectacular gains. All depends on how these diversified portfolios respond to volatility changes and correlation changes, and these are random variables. So this is the website, free trading book if you subscribe. This is how to contact over here. This is the X and Bsky handles, Substack, YouTube, 2 channels, Medium. That's where you can find my work and articles, free material. And if you subscribe for notifications, email notifications, you get the free book, Profitability and Systematic Trading, published by Wiley in 2008. That's an introductory trading book, free of charge. If you like this video, please hit the like button and also subscribe. Have a nice day.